Welcome to the deep dive. We often look for those stories hidden in the business world, right? Today, it's about a company that honestly kind of flew under the radar for a long time, seen as just, another player, but then one quarterly earnings report comes out, and bam, the whole narrative just flips.
It really did. And today, that's our focus. Celestica, Global Electronics Manufacturing Services. We're going to unpack their Q2 2025 earnings. The mission, basically, is to figure out how this company went from being sort of underappreciated to what some are calling a market darling. We'll be digging into an article by Tony Hicks, Celestica Q2 2025, exceptional earnings restore bullish case, plus, of course, the actual numbers.
Yeah, and that's the fascinating part for me, how these numbers, which can seem pretty dry on the surface, how they actually reveal this huge business shift. And importantly, what it tells us about bigger trends, like especially this massive AI boom everyone's talking about. Let's get into it. Okay, so let's set the scene first. Celestica before this report. For years, the perception was, well, they're a contract manufacturer, stoke fighting for, slim margins in a really tough field. Just imagine trying to break out of that box to tell the market, hey, we're actually more than that. That must be incredibly difficult.
Incredibly difficult. And that perception, the Q2 25 earnings just shattered it. Absolutely shattered that narrative. The core change was impossible to ignore. You had revenue shooting up, profits exploding, and their forecast for the future lifted way, way above what anyone expected. So this wasn't just beating estimates. It felt more like a bold statement. Strength, execution, smart positioning, all rolled into one.
And you could see it in the market reaction, too. These numbers definitely got people talking. One of the biggest upside surprises of the whole earnings season, apparently. So let's look at some of those figures. Revenue. It jumped, over 20% year over year? Came in close to $3 billion.
Yeah.
That really smashed the consensus estimates.
It really did. And the profitability side was maybe even more impressive. Adjusted earnings per share, that's a key operational measure, leaped 54%. Just huge.
54%. Wow. And the GAAP EPS.
That one rose an eye-popping 128% to $1.82. Now, part of that was operational efficiency, which is great, but there were some one-time gains in there, too. Still, very strong.
Okay, and margins expanded, too.
Yep. Non-GAAP operating margins hit 7.4%, up from 6.3% the year before. That's significant in this industry. And free cash flow, super important for funding growth, that nearly doubled, around $120 million.
So what does all this actually mean? For a company that people kind of wrote off as just a low-margin assembler?
It means transformation. I mean, fundamentally, these results signal that shift. They're not just assembling basic stuff anymore. They're proving they can win, high-value business. And critically, turn that business into profit at a speed that, frankly, looks more like some of these hot tech stocks than an old-school manufacturer. They're embedding themselves deeper into things like, AI infrastructure, which is much more lucrative.
Okay, so digging a bit deeper, where did this growth actually come from? You mentioned they have two main parts to the business.
Right, two segments. Connectivity and Cloud Solutions, CCS, and Advanced Technology Solutions, or ATS.
So CCS and ATS, which one really stole the show this quarter, and why?
Oh, no question. It was CCS, Connectivity and Cloud Solutions. That was the undisputed growth engine. Revenue there surged 28% year over year, hit about $2.07 billion. That segment alone is now over 70% of Celestica's total revenue, so it's massive.
70%. And what's driving that specifically?
Primarily, it's the hyperscalers, the big cloud companies. They're spending heavily on cloud infrastructure and, crucially, AI hardware. And get this specific detail. Communications hardware within CCS, things like high-speed networking gear, that part skyrocketed by 75%.
75% in one specific area. That's incredible.
Yeah.
Is that just the market being hot, or does Celestica have some kind of edge there?
I think it's probably a bit of both, actually. Yes, the AI networking market is absolutely on fire right now. That's undeniable. But Celestica has also done the work. They've built relationships with these hyperscalers over years, and they've invested in the specialized manufacturing capabilities you need for these really complex, high-performance parts. We're talking critical infrastructure here, and they can make it at scale. So it's not just assembly line work.
Got it. So specialized capability meeting huge demand.
Exactly. Now, there's a little nuance within CCS. It wasn't all up. Enterprise storage and server hardware revenue, that actually declined 37%. Seems like customer priorities shifted a bit there. But that explosive growth in the AI networking stuff more than made up for it. And the result for the whole CCS segment was an 8.3% margin, which again is way up from last year.
And the other segment? ATS.
Advanced Technology Solutions, yeah. That saw growth too, just not as dramatic. Revenue up 7% to $819 million. It's important, though. It provides diversification, stability. Think aerospace, health tech, industrial customers. And its margin expanded, too, to 5.3%. So solid performance there as well, just overshadowed by CCS this time.
Okay, so we've seen the what, these amazing numbers, but let's talk about the why. Why this quarter? What were the key factors, the catalysts that really came together to make this such a pivotal moment for Celestica?
That's the crucial question, right? Why now? Several things seem to be converging. First, clearly they're riding the AI wave. And this isn't just hype. It's a massive technological shift. Global AI spending. I saw a projection, something like over $500 billion by 2027. Huge numbers. And Celestica, they're positioned right in the middle of it, a key supplier. Their high-speed switches, custom hardware. This stuff is becoming absolutely critical for the hyperscalers building out their AI infrastructure.
So right place, right time with the AI boom. What else?
Second, operational excellence. You really have to give them credit here. Margins didn't just expand because demand was high. They improved because of, better cost control, more efficient supply chains, a better mix of products. It shows real discipline. It's one thing to get revenue, another to turn it into profit efficiently. They did that.
Okay, AI tailwind, operational discipline, anything else?
Yes, third point. Capital discipline, financial stewardship. We mentioned free cash flow nearly doubling. That shows they can fund themselves. And management was disciplined with that cash, too. They used about $40 million for share buybacks, returning value to shareholders. Plus, they have a healthy balance sheet, low debt. That gives them a lot of flexibility for whatever comes next.
That does sound like a management team feeling pretty good about things. Which brings us to the guidance, right? Raising the forecast for the whole year.
Yeah.
What does that really signal about their confidence level?
Oh, it signals a lot of confidence. It tells you they don't see this as a one-quarter blip. They think these trends are sustainable. So the new numbers. They now expect full-year revenue of $11.55 billion. That's up from $10.85 billion before. Big jump. Adjusted EPS, they're now calling for $5.50, up from $5 previously. And free cash flow forecast is now $400 million, up from $350 million. And even just looking at the next quarter, Q3, the guidance was strong. Revenue between roughly $2.9 to $3.1 billion. Adjusted EPS between $1.37 and $1.53. It all points to continued strong momentum. Management clearly believes demand will stay high and margins will hold up, maybe even improve.
And the market obviously liked that message. You said the stock surged.
It really did. Shares jumped, I think, as much as 17% in the days right after the earnings came out, hit new all-time highs. And the technical chart watchers, they were pointing to a very bullish setup, lots of positive momentum.
So analysts must have reacted too.
Oh, yeah. Upgrades, higher price targets, the usual response to such a strong beat and raise. And what's interesting is how this sort of restored bull case seems to rely on three pillars, growth, margins, and valuation.
Okay, break this down. Growth.
Growth is all about that AI infrastructure boom. It's still relatively early days, right? Hyperscalers are deploying 400 gigabit, 800 gigabit networking gear. 1.6 terabit stuff is already on the horizon. Celestica is just perfectly positioned, it seems, to grab a big piece of that action.
Makes sense. And margins.
The margin story is about the type of business they're winning. It's shifting towards these higher value solutions. This isn't the old commoditized manufacturing game anymore. They're providing more complex, essential technology, and that commands better profitability.
And valuation. You're saying even after the stock jumped, it's maybe not that expensive?
Well, that's the argument. Even after the rally, if you look at its forward price-to-earnings ratio, the PE multiple, it's still trading somewhere in the low to mid-teens. And many analysts look at that and compare it to other companies in high-growth tech hardware, and they say, that actually looks pretty modest. Yeah. It suggests there might still be room for the stock's valuation to catch up further, a re-rating.
Okay, strong bull case. But, we always need to look at the potential downsides, too. What are the risks? What challenges or headwinds could potentially derail this story for Celestica?
Absolutely. It's crucial to keep a balanced view. And there are risks, for sure. One is customer concentration. Relying so heavily on just a few huge hyperscalers. Well, that's great when things are good, but if even one of those big customers changes strategy or hits a slow patch, it could significantly impact Celestica. That's a vulnerability.
Right, putting all your eggs in a few very large baskets.
Sort of, yeah. Then there's potential weakness in the enterprise IT market. Some sectors are pulling back on spending, and that could affect parts of their business. And of course, geopolitical uncertainty is always a factor for a global manufacturer like this. Think tariffs, trade disputes, potential supply chain disruptions. That stuff is always lurking.
And the others? Competition.
Yeah, competitive pressure. Right now, Celestica seems to have a good position in AI hardware, but you have to wonder if some of the even larger contract manufacturers might try to muscle into the space more aggressively if the margins look attractive enough. So these risks exist. They don't seem to be overshadowing the positive story right now, but you absolutely have to watch them.
Okay, so keeping those risks in mind, what's the plan going forward? What are Celestica's main strategic priorities now?
Well, management laid out a few key things. First, obviously, keep expanding that AI hardware production. Meet the demand. Second, keep investing in innovation. Develop new, differentiated solutions, especially in networking and compute. Don't just rely on today's tech. Third, continue optimizing the supply chain, maybe more localization of production to reduce risks, improve efficiency. And fourth, careful capital allocation. Balancing those share buybacks with reinvesting in the business and maybe even looking at potential M&A down the road.
It really is a fascinating story, isn't it? A real case study in how a company can, well, reinvent itself, reposition itself in an industry that's changing so fast by aligning with these huge growth areas, AI, cloud, and just executing really, really well on the operational side. They've managed to transform from being seen as, just an assembler into a high-value player, enabling all this next-gen tech.
Absolutely. And I think the key takeaway is that these Q2 results, they weren't just a fluke, not a one-off. They feel like the result of years of strategic investment, hard work on operations, and catching some powerful market tailwinds at just the right moment. And with demand for AI hardware looking like it's only going to accelerate, Celestica seems really well placed to benefit, maybe disproportionately. So maybe the final thought for you, listener, is this. How often do we overlook these companies that are quietly building the essential plumbing, the infrastructure for the next big thing? Recognizing these kinds of transformations, well, it can lead to some really significant insights, not just about investing, but about where the whole economy is heading.